Trump's student loan rollbacks, a crisis for borrowers. Are student loan protections crumbling before our eyes? The Trump administration's actions have sparked a debate about the future of student loan forgiveness and repayment programs. Let's dive into the details and analyze the potential impact on millions of Americans. The CFPB, established after the 2008 financial crisis, was designed to protect consumers from financial abuse. It had a strong track record of holding student loan servicers accountable. The agency recovered over $21 billion for consumers and operated a complaint system to resolve disputes. Its enforcement actions targeted entities like National College Student Loan Trusts and Navient. However, the Trump administration quickly moved to weaken the CFPB. Enforcement actions were halted, key staff were fired, and oversight was significantly reduced. This included dropping a case against PHEAA, a major student loan servicer accused of unlawful collection activities. Critics argued this move favors powerful financial interests over borrowers. And hey, if you haven't subscribed yet, now is a great time. Every month I break these updates down in simple, clear language so you know what's going on and what to do next. It's completely free, and it helps more people in our community stay informed and supported. Subscribe to Now Nest for more in-depth analysis of financial policy and economic trends. The Trump administration also targeted the Department of Education's student loan operations. Staff buyouts led to a reduction in personnel within the Office of Federal Student Aid. This included staff in the Ombudsman Group, which investigates borrower complaints, and the Borrower Defense to Repayment Unit. Further cuts to staffing, budget, and operations were anticipated. These cuts could limit borrowers' ability to submit complaints and access support. Reduced call center hours and a canceled web portal upgrade further complicate matters. The implications are significant. Fewer resources to handle borrower issues and oversee the complex student loan system. This raises concerns about accountability and fairness. Perhaps the most disruptive action was the Department of Education's decision to block access to Income-Driven Repayment (IDR) programs. This decision followed a court challenge to the SAVE plan. IDR plans allow borrowers to make payments based on income and family size, with loan forgiveness after a set period. The department took down online and paper IDR applications and halted processing. While the legal challenge focused on the SAVE plan, other IDR options like Income Contingent Repayment (ICR) and Pay-as-you-earn (PAYE) were also affected. Even income-based repayment (IBR) was blocked. Borrowers seeking to enroll in IDR plans or pursue public service loan forgiveness (PSLF) were unable to do so. Those nearing forgiveness under SAVE, ICR, or PAYE faced delays. The combined effect of these actions is a significant reduction in protections for student loan borrowers. With the CFPB weakened and Department of Education operations strained, borrowers have fewer resources. Borrowers are struggling to navigate the complex student loan system and access the repayment options they need. Many are being pushed into unaffordable repayment plans or costly forbearances. The long-term consequences could be devastating. Increased defaults, financial hardship, and a loss of faith in the student loan system are all potential outcomes. Policymakers must carefully consider the impact of these changes and explore alternative solutions. Protecting borrowers and ensuring a fair and accessible student loan system is crucial for economic stability. The Trump administration's actions raise important questions about its priorities and motivations. Were these changes driven by a desire to reduce government spending, or were there other factors at play? Some argue that the administration sought to reduce regulatory burdens on the financial services industry. Others suggest a philosophical opposition to student loan forgiveness programs. Regardless of the motivations, the impact on borrowers is undeniable. The dismantling of key protections has created uncertainty and hardship for millions of Americans. A thorough analysis of the policy implications is essential. We must examine the long-term effects of these changes and consider alternative approaches to student loan reform. What can be done to protect student loan borrowers in the face of these challenges? Several options are worth exploring. Strengthening oversight and enforcement is crucial. Restoring the CFPB's authority and ensuring adequate resources for the Department of Education are essential steps. Simplifying the student loan system and improving access to new payment options is also vital. Streamlining the IDR application process and providing clear, accurate information to borrowers can make a big difference. Finally, addressing the root causes of student loan debt is necessary. This includes controlling tuition costs and exploring alternative funding models for higher education. Stay informed about the latest developments in student loans and financial policy by subscribing to NowNest. We provide in-depth analysis and expert commentary to help you understand the complex world of finance.